And good afternoon, everybody. Good afternoon, good morning if you're out here on the West Coast as I am, or good evening if you're tuning in, from Europe. My name is Michael Filighera. I am the owner, proprietor, trader, analyst with TradersHelpingTraders.com, LogicalSignals.com, and I am the StormPodcast.com. And a little bit of history on me, for those that may not know me. I began here in San Francisco as an options market maker on the Pacific Exchange on the options floor. And I have also traded as an options market maker on the London traded options market, the European Options Exchange, which was in Amsterdam. And my introduction into electronic trading was via the DTB, which is the German exchange, also during my time of living in Amsterdam. I came back to the United States in 1997 and returned to the Pacific Exchange and traded for about 3.5 years until the markets really were all going electronic. The floors were kind of dying off, and it seemed to be a good time to stop being a floor trader and start being a trader from my home office, which I did do. Again, I was an options trader for many, many years, so I continued to trade options until I started to not really wanting to deal with overnight volatility and just how the markets were actually trading at the time. And so then I changed and became a day trader. And so from about 2013, so about 10 years, I have been focusing on day trading. And so within that realm, I have a trade room, and I also produce a daily update, my Elliott Wave update, on YouTube, and I post that on YouTube. I have a couple of channels there, and where I go over the daily picture for the S&P 500 and the NASDAQ 100. I also produce a weekly big picture update, and that I do as a podcast. And then I also have some guests that I have, and so I do those via a podcast. And today, I'm here to discuss what is on your mind. And but I'm going to start just this conversation, as I think many have already done so far today, is I'm going to just start with the S&P and actually with what's been going on recently in our markets. And there's been such a stall, actually, but it seems that yesterday things really started to kick off. And that has continued through today, as a lot of the wait and see was surrounding whether or not we were actually going to be confronting a national default, a Treasury default on our obligations, having the country and the Treasury unable to pay our bills, our obligations. And not that it really struck a very super negative tone from the market, although I think it probably should have. They didn't seem to do that, but they held it to a very, very tight range. And there were a lot of questions, a lot of pundits, a lot of talk about, well, what will happen and what could happen and what interest rates should do. And do we really have a banking sector crisis? Is there really going to be all of these banking failures, et cetera, et cetera? And then we get all of the talk behind all of that. So in one way, it's what we get from our financial media, but on the other hand, it was a lot of, I think, of confusing information. As far as the debt ceiling goes, what started yesterday and followed through today is this, what I'm calling the relief rally. Now, they may be a little bit premature on that, but we did get the Speaker of the House, along with the representative or the spokesperson for the White House, coming out and saying, yes, progress is being made. And, it looks like we will be able to reach an agreement to raise the debt ceiling. Beyond that, I don't have anything else, that's all that we actually heard. That was enough to really propel the market substantially higher yesterday. But I think what's behind that, we need to have a little bit of understanding. And this is where I'm going to bring in another relatively new option trading strategies that are in play. And they're what they call the zero DTE options. And those are 0 days to expiration. So, and actually when they come strongly into play would be on the day that they're going to expire. And what I can do is quickly just kind of put up the SPX, which again, that was yesterday. Let's go to today. So these options, they've been trading for, a week or so. So there's some of the longer positions that have already been in play, but the real positioning, the real heavy duty trading comes in today. And it really starts last night as Globex opens. These options become available to trade as well. And so they got the future, and then when the options open, then they can start trading the options. Now, the deal behind here is these options expire today. So we have what they call 0 DTE options, and there's a lot of trade happening in here, because not only do we have it in the SPX, but we have it in the ES, we have it in the spiders, we have it in the Qs, we have it in the NDX, we have it in the NQ. So again, a lot of the ETFs have now started trading 0 DTE, so they expire every day of the week. So initially that started, we would have weeklies. So they'd start on Monday and then they'd expire on Friday, but the heavy trading would begin on that Monday of that week. So now they've added, and then they added a Monday, Wednesday, Friday, and then now they just filled in the blanks. So we also can find some of those over within some of the treasury markets. So it's added an additional dynamic to trading and how our indexes move, what influences a move to the upside or to the downside, and then how that all plays out by the end of the day. So 0 DTE options actually now are taking about a little bit over 50% of the daily options volume. And mind you, that's huge. And maybe you can see it here. Right now, the heaviest option are the 4180. And if we add it to that, but if I go over here and I start looking to where the calls and the puts, because they get combined for total volume, it's likely going to be somewhere around 4170. 4180 was big because they ran it up to 4186. Now, the reason I'm bringing this up is like what happened yesterday. Again, let me go back to my chart. Yesterday, we got this fantastic rally that absolutely just went bonkers, right? First, we got the little bit of blurb that we're likely to reach an agreement. Bam, and then the response back out of that was to sell it immediately. So in essence, what it kind of was a very, very quick buy the rumor, sell the news, but the news wasn't out yet. So then that's just started the buyers to come in. And right about 11:15, so right within this bar here, there was a massive, like a floodgate opened, and they came in to the 4160 call. Or they were just buying tons of calls. But I believe that the one that really came into play was the 4160, which was at the time didn't have any value. It was like they offered at 5 cents, or maybe it had a little bit higher, and suddenly it was trading at $6. Well, that then, of course, you got to flip around, and what's the hedge? The hedge is it opens up a floodgate for a buy in the futures market. And so we saw flood, boom, boom, and so just really run up. And then what seems to happen every single day is that there's a point to where the market and the market makers, the players within those options, are going to pin the future and pin the SPX at a particular strike price. And that's also a play within the 0 DTE options. So they have kind of taken over, so much so you actually can do both. To answer questions, say, do we buy call and put? You can, and that would be a straddle, but just depends on what your strategy is and what you're trying to either hedge or take advantage of. Now, mind you that when you've got a lot of the larger trading firms and a lot of dealers, so to speak, or market makers that are in here trading, they're going to be selling premium. So it's what we would call through the moves. They may, buy something and then the market runs in one direction or the other, and then it gets to what we call monetizing. So they're going to want to monetize that position by selling it, actually, or if they were short, by then taking it back in and buying it to get flat. So you monetize the position, and there's a lot of to do with it. You might hear people talk about the gamma. What is the gamma? Where is that moving? And so what happens is there's different calculations that come in, and so they're combining the largest traded strike, call and put, and then what the gamma is. As the gamma grows in like positive gamma, the market's usually going to be moving up, and vice versa. As the market starts to sell off or just change direction, then the gamma changes as well. And when things get monetized, and that releases all the gamma that was involved in that particular trade. So you get these changes all day long, and you get adjustments in the future. It's not an easy product to trade. In fact, there's been many articles that have been written stating that, that retail, that's us, right? Anybody that's not associated with the firm, we're all retail. Even though I was a professional trader, I'm still considered retail now. And that what happens is if you don't have the right access, or you don't have the ability to kind of put these trades on, monitor and trade with, because you're not understanding the functionality of what happens to premium and as these things move around. And so what has been reported is that, up to like $385 million a day being lost by traders coming in and trying to trade zero DTE options. Now, what I will kind of show you, again, going back over here, this is just the SPX. But when you go over to the spiders, again, smaller contract than the S&P, of course. But look at this, look at the volume in these options, 350,000, 321,700. And then you go over and you add the puts, like on the 417 put and call, the puts 233,500. The calls 351,000. So you combine that, it's like the numbers are enormous. And so it's also increased the volume in the spider itself, in the underlying. And so there's been so much change in the options more recently, and all of these zero DTE options coming into play, plus the weekly options. And so it almost gets to a point where I've heard people say, you know what, we used to consider, for example, the spider, that ETF was the underlying, and the options are the derivative. It's almost now where people are saying, you know what, the options are the underlying and the ETF is the derivative. Kind of, upside down, but when you really look at it, it can be true. So back to the chart. I am also an Elliott Wave analyst, and I've been working with and using Elliott since about 1989. 1990 for sure, that I was creating my own chart. And I didn't have the luxury of a wonderful system like the Thinkorswim platform or most other platforms that include charting. We created our charts, and back then it was in the same way that R.N. Elliott, who wrote and the whole theory, the whole principle, which is named after him, of course, that how he collected his information is that once an hour, so whether it was at the top of the hour or from the opening, whatever the deal was, every hour he would notate where that hour closed in terms of the price of that index. And at the time, he was using the Dow Jones. So, and then he would plot that on a chart. So when I first started, I was trading the European Options Exchange Index. I was living in Amsterdam. And so every hour I took out my trading card and I notated what the close was of the index. Go home that afternoon or evening, and I'd plot it out of my chart, and then I'd connect the dots, so to speak. And so that's how I developed my counts, and I developed my longer term counts. And now I have the luxury of being able to pull in the SES, I can go all the way back. I think this is 1983. If I actually go over, you'll love this one. If I can go over to the SPX, I can go back all the way to 1928. If I pull up the Dow Jones, I'm going back to 1902. So you have this total big picture look at our major indices. NASDAQ, yes, we can go back, but don't forget the NASDAQ 100 is just really from the late 70s, I believe, has been trading and didn't become more popular until the 1980s. And then, of course, as it got more and more popular, it went from the NASDAQ composite, and then they formed the NASDAQ 100. So, and again, that was in response to the S&P, because if there's us older traders, and I'm putting quotes around that, you're going to remember when they came up with the OEX. And that was designed and put together by the Chicago Board of Options, which is the CBOE. And that was the 100 heavily capitalized or weighted stocks within the S&P 500. And I think it was basically tech. And so then the NASDAQ came up with the NASDAQ 100, which is pretty much pure, at the day, was pure tech. Now, but here I can develop my long-term picture. And these are basically super cycle degree. Those are very long. And what I think we finished at our highs here, excuse me, at our highs in the S&P back in January of 2022, I believe we just completed an super cycle wave 3. So that encompasses all of this activity. So when you're talking about it, and you have to say that's the bull market. That's a long-term bull market, a long-term rally phase in the S&P 500. Included within it were declines, were wars, were recessions, were other, activities that took place. So we had lots of things go on, and particularly in this one, this is the great meltdown of 2008, 2009. And you can see, I won't do it. I got to go back out and go back to it. So that massive decline, which was considered its own little crash, is nothing but a little blip on a very long-term chart. And what you're seeing up here are my calculations for what I believe is going to be a supercycle wave 4. And if we really take a look at it, it's, we're going from 4,818, and over time, what are we looking at? Maybe, it's going to be a significant decline, but in terms of where we're going to end up, back in this area, maybe back in this area. And if I bring this all the way back down and I start looking at it, when we're trying to determine, well, what should this first leg? So let me just kind of give you a real quick overview of what's kind of going on. If we reach a supercycle degree top on January the 2nd of 2022, it is from that moment that the bear market began. Wasn't declared such, but that's where the reversal and the correction began. So what is that correction going to entail if we're really going to be in a supercycle wave 4, right? So it's going to consist of 3 waves. So the basic premise on Elliott was impulse, whether it's up or down, an impulse wave is counted as 1, 2, 3, 4, 5. The corrective waves within it are labeled as ABC. So when we're counting down and we're realizing, okay, supercycle wave 4, what's it going to consist of? I'm going to come down my ladder here. Supercycle, what's the next one down? Cycle degree. Well, what's going to be inside these cycle A, B, and C, right? Because it got to have 3 waves to complete that cycle 4. The supercycle 4. Well, then I come down one more. What's going to be in supercycle? What's going to be in cycle wave A? 3 waves, a primary degree, labeled ABC. What's going to be in primary wave A? 3 waves of intermediate degree, labeled ABC. Now, that's the yellow, A, B, C. So we've done primary wave A, that's the October low. Now, everybody declares the October low as a major low. And in essence, they're not necessarily wrong. But what produced after that is a counter trend rally. This showed us that the trend is down right now. Anything going in the other direction is going to be considered counter trend. Now I finished a primary A wave. So I'm going to be in a primary B wave. Well, what's going to be inside that primary B wave? Again, 3 waves of intermediate degree labeled A, B, and C. Now I can come out of, so we got so many lines on this. Let me bring this down quickly to my daily, because these are all fib lines. And on my daily, there's primary A. What am I working on? Well, I've already got intermediate wave A, intermediate wave B. I got this intermediate C wave going up. What's going to be in that C wave? Well, if you study Elliott, Elliott tells you all C waves are 5-wave affairs, 5-wave structures. Okay, intermediate degree, I got to drop it down. What's inside this intermediate C wave? 5 waves of minor degree. Here they are labeled 1, 2, 3, and 4. So we're in minor wave 5. Now, what am I expecting out of minor wave 5? Well, first of all, I'm looking for it to take out the high of minor wave 3. We finally did that today. What am I then looking for out of intermediate wave C? I would like it to take out the high of intermediate wave A. That's going to be, and this is SPX, 4,200. I want to tell you where that call wall, in other words, this line of resistance in the market via the SPX, 4,200. That is where it's going to meet a wall of resistance. I needed to just get slightly above it, produce a new high, and then we're done. So now I'm starting to put together, well, what's this all going to look like coming off? So again, now we're using a 4-hour chart, and you can start to see some of these inside moves. Now I'm going to bring it down to an hourly chart, and now look, now it becomes very clear. And all of our resistance levels on our expected move up become even clearer. So it all becomes very, very interesting. And there's a couple of things I want to add in here while we're talking about it. And I'm going to put it in to what I think. 1, 2, 3, 4, 5. It could be only 3. And so we're just looking at a 4th wave, and we still have a 5th wave up. But I can come back down to here. As you see, what I've done is I'm adding Fibonacci levels to my expected minor 5th wave run. And within it, I have it to here, and those are these levels. Then I ran my inside, because I figured I had a 1 and a 2, and I'm looking for this run for wave 3, and that takes me up to here. When that's done, I will add an additional, right, because I'll look for a pullback, which we may be getting now. I will look for an additional line that I'm going to add more Fibonacci that are going to start to hone in on where I think this all ends. So if I just go back to minor wave 5, which is where we are now, I can add things to it, because now I'm looking at, okay, minor wave 5 is closest relative and compared to would be minor wave 1. To get a look at that, I got to take this out, at least to the 4-hour. There's minor wave 1. Now, the first comparison that you make is that minor wave 5 will be equal to minor wave 1. So that's what we call equality. And that, my friends, minor wave, these are what we have. Equality is up here at 4281. And all that does is I'm taking minor wave 1, which I believe was 232 points, adding that to the low of wave 4, and you get 4281. So now I can add more because I'm just going to track my way up. Remember that in the SPX, that in intermediate A wave of my primary B wave was at basically 4,200. I needed to get above. Well, right now, my next calculation for this minor fifth wave is that minor wave 5 would be equal to 0.618 of the distance of minor wave 1. That's at 4192. Okay, that gets me above minor 3, which I need to see. You're always going to look for the fifth wave to take out the high or the low, depending on your direction of that third wave. Well, that's right here. It fulfills that. What it doesn't fulfill is for wave C topping out above wave A. So what can I look for next? Well, what I have on board is that, well, the last calculation that I can use and comparing minor 5 to minor 1 is that minor wave 5 will be 1.618 times the length of minor wave 1, 4270. That takes out the high of that intermediate wave A, gets me dang close to minor 5 being 100%, but doing the internal calculation, it gets me up to 4270. So outside of that, if I did it straight out, 1.618, it takes me all the way to 4424. Now, technically, you have to include these numbers. Technically, you have to. That does not, it only is potential. You still have to factor in, how's the market going to get up there? What kind of catalyst is going to take the market up to that level? There always has to be a catalyst. Our rallies yesterday and today, the catalyst was, oh boy, whoo, relief, we're not going to default. No, that's all not going to happen. Whether we want to call it BS, or whether we want to call it nonsense, whatever we want to call it, fact is they did it. And what started it? Algorithms. There are algorithms that are keyed to pick up phrases in news, in a news report. And the one that was running picked it up, agreement close, or whatever they were talking about, they picked it up, they translate it, and it comes back with a buy. This is how we operate now. And there are a lot of algorithms that will do what they call a stop run. When you're using other instruments such as like Bookmap gives you the luxury of telling you where resting orders are. Usually within those resting orders are a whole bunch of stops. So if they can see there's a 100 lot, there's a 200 lot for sale up at that level, and you're a buyer, and so you have X amount to buy, you can program it to go right up to that level. So you're going to take everything up to that level. And then you may keep going, trigger the stops, and then reverse. You're going to see this day in and day out, day in and day out. Just watch. They do it all the time. Because a lot of people say, oh, come on, they don't really have those, do they? It's like, yeah, they do. And they're very, very popular in the S&P. And in the NASDAQ, for that matter. So, and that's just having an understanding of really what is the auction process. Where do we go when we're trading? And we have thoughts of we have value areas. So in essence, when the buyers have a large order, what are they really seeking? They're seeking value. They have to find value. And that's the level where the buyer and seller can meet because they agreed on the value of the S&P index, the value of whatever that underlying is that they're looking to transact in. And so when you're seeing aggressive sell orders, it's just they just got a lot to sell and they're just looking for buyers for that value. So this is what happens. And so that's what happens all day long. So there's a lot of things that are in play every single day. And that's basically why I've chosen to become a day trader. Now, my thought process on the S&P basically has remained the same, because again, if I take it out, at least to the 4-hour, this is what I'm walking through. Now, if you listen to my updates, there were several times it was like, well, there was the possibility that the entire larger primary B wave completed there. Why? Because I was looking for a 5, I was looking for completion. And here I had 1, 2, 3, 4, 5. Okay, C wave complete, possibly. But I try to give both sides to a picture. I had my calculations of where the market likely will end up if I'm just using Fibonacci and the Elliott. So at this time here, I was basically saying this would be considered a failure because we didn't take out that high. Not by much. It wasn't that big of a failure. In the futures market, it was a bigger failure. So, and then we came down and we're still now looking for this upside, but we went into this period of sideways. So here again, 1, 2, 3, 4, 5. I'm like, oh, wow. Could this be another failure? That possibility existed because the market just did sideways moves. And it was totally controlled by 0 DTE options. We do the sell-off, we'd run it back up, we'd sell it off, we ran it back up, we sell it off, we run it back up, et cetera, et cetera. And it continues to happen today. Now, finally, we get the move. So I was able to, at least in the NASDAQ, I counted it out. And now I can likely do it here, that this is likely wave 1 of minor 5. And all of this is likely wave 2. Or I can call this wave 2, and this is 1, this is 2, this is 3. We're coming off in a 4, and we still have 1 more to go. Could we get this done by tomorrow? We could. We could. Absolutely. What also influences what we're going to do? Tomorrow is a weekly expiration. Tomorrow is also, I believe, let me just check my calendar. I think it might be a monthly as well. And let me just take a peek. Yes, it's also a monthly expiration. So not only is it a weekly, it's a monthly. And then you have the daily. So we got, all 3. So there's a lot of activity that'll go on. And because what also then starts to expire tomorrow, instead of just these daily that we have in our indexes and some of the ETFs, tomorrow we have it in all these underlying of all these stocks. So, now you're going to start to see where's that going to expire. And you can basically do the same thing. You start to look at where, we can go over here and I can look at Apple. These are the options that expire tomorrow. Look where they're rallying around, 175. Oh, gee. You can see how they're doing that because they're pushing and they've got up to 175. So here you go. They come alive. Volatility, still not actually that high. So volatility, you can put an equal sign next to that, and it's called premium. If you're an options trader, you're interested in selling premium. That's how you're going to make your money a lot of the times. It isn't just buying a call, hoping that the stock goes up and beyond that price, your strike price, and then being able to cash out. So as a dealer, as a market maker, you're always looking to sell premium. And so if I'm selling call premium, what's the outside? The outside is I sell the call and I buy the stock. So that can produce a lot. Here we have 144,000. Here in the puts, if they start selling these puts, you sell the put to collect the premium and you sell the stock. That's the hedge. That's how you neutralize that trade. So this all is going to go on. And as these things float around, and as we continue to work through our quote unquote relief rally, we're not going to, collapse. You have a lot going on. So this is why I also talk a lot about mindset. I talk a lot about just as I caught the tail end of Tony Hansen's presentation, and she makes it very clear, do not step into a market unless you've got your trade plan, AKA trade rules. I also hate to use the word, but I'm going to use it, preach the same thing. I think it's a recipe for disaster. If you walk into a market, particularly, I don't care what market it is, but let's call it the ES, which is going to move much more freely than the S&P, the SPX. You know, we zipped, we almost touched 41.99. Now, putting this together here, ES to SPX. SPX is the cash market. ES is the future. The ES right now has approximately 71.83, about $11 or $12 of premium left in, because it's the June future. So this will trade until, the third week of June. So it will continue. You pay interest. You buy this, you've got to pay the interest because you're working on margin. So that's all included in the price, but that's also called premium. So that will contract day by day. Tomorrow you will see more come out. Why? Because we have a Saturday and Sunday. They'll take that volatility out. They'll take that premium out for the 2 days. So you'll see this start to trade. You'll see volatility go down. Now, oh, look, markets are down. Well, right? ES is still up based on the NASDAQ, but the Dow is down. The Russell's down. Volatility, because the volatility is based on the ES options, the SPX options. And so those are up. So volatility will get sold off. Maybe it's a little bit too much, but still, they sell volatility, they take those proceeds, and they buy zero DTE options. A lot of things going on behind the curtain, folks, and that affect your trading, that have nothing to do with taking a bullish or bearish posture. That's the other thing I talk about. I'm a day trader. I don't declare that I'm bullish, I'm bearish. I follow the price action. I will buy it on when this market is roaring up here. Why wouldn't I buy it? Right? I'm a day trader. And even within that realm, one of my favorite things to do is scalp. You can be a swing trader and still be a day trader, but I'm even more short term. I'm sitting and trading off of a 2-minute screen. So your whole mindset has to change. When you're using Elliott Wave and you're trying to keep it, you've really got to keep a lot of things in place. You can day trade using Elliott. It can give you a lot of hints and a lot of trades, but be careful about counting incorrectly. You can catch yourself and you're just going to get caught, and you can lose a ton of money when stuff like that happens. So getting back to just the conversation. So I really do talk a lot about your trade rules. Now, your trade rules are going to be different than my trade rules only in our individual risk profiles. If you have a large account, your risk profile is going to be different than somebody who's maybe trading $25,000, $50,000, or $100,000. You got to keep pretty tight reins, even in the futures market, particularly in the futures market. You've got to keep tight reins on a $25,000 account, a $50,000 account, $100,000 account. It's very easy to blow them out. It's real easy to blow them out. And because as Tony mentioned, and that I talk about a lot, here are the 3 trade rules that I say you must be able to verbalize before you enter a trade. First of all, what's the trigger? The trigger is your entry point. If you're trading using moving averages, that's one thing. If you're trading using an order profile, you've got that. If you're trading using just price action and via bookmap, you can see that it's aggressive sellers or aggressive buying. That's another thing. That's your trigger. Second thing you really got to know What's your goal? What's your target? If you're trading off of the moving averages, and I can see that it's breaking down below the 4 and the 8, and that'll trigger the buy or the sell, then what am I normally looking for? Either a support line. In this case, if they started to come down, I'd look for they're going to head for 41.73, or they're going to head for the 20, which happens to be at 41.73. So you got a double there. That's my target. That's where I think it eventually should go if it starts to break down. A lot of factors right now are not allowing the market to break down. So you got to keep that in mind. Okay, I still will sell it if I get a sell signal, but what's going to be my target? What am I not going to look for? Well, I'm going to even shorten that a little bit more. Maybe I only want to make $100, $150. That's going to be 4 ticks, or 8 ticks, or maybe 12 ticks. 12 ticks, 4 ticks to the dollar. So you're looking for a $2.50, $3 move in your index, and you trade one lot. Now, you can still go for that $150 or $200. If you're trading a 2 lot, you're increasing your risk, but you'll make your money a lot quicker. So this is what I'm talking about. When you put your trade together, you're going to put position sizing is one thing. Risk is your most important gauge. You have to really be careful about your risk. And as Tony mentioned, I will also back that up and say one of the biggest mistakes I see traders make is they say, yep, I'm going in, I'm looking to make $500 on the trade, and I'm only going to risk 250. Okay, great. I like it. Did you put your stop in? No, it's a mental stop. I got it. I'm in control of this. Suddenly they get in. The market wasn't ready to go in the direction they got. It starts to turn and go below, and you've reached that 250. Did they get out? No, it's going to turn around. It's going to turn around. And that moment, what's happened is the trader has broken their mindset. How? Because the mindset gave them all 3 as they got into the trade. They let the 3rd one go by. And so what? And now, how did they break the mindset? Market's it's gonna turn. It's gonna turn. I saw the buyers. The buyers are gonna come in. It's gonna happen. So I'm gonna stay long here. Bing, 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 bing. Now you're down 350. It's gonna turn. It's gonna turn. Now you're down 500. You still haven't taken out your stop, and you're only looking to make 500. You're now down 500. So you're at a 1-to-1 at best. What do a lot of traders do? I'll add a contract down here. I got to lower my cost. You've just increased your risk. Now, you've really broken your mindset because you've now playing games with your own risk profile. And maybe you are trading a smaller account, but no, the market's going to turn around. The market's going to go my way. Now, it may, and in most cases it does, but at that particular moment, when you got triggered in, the market was not ready to stop selling. If that's what they were doing, they had more to sell. It does not mean you're wrong. It just means they weren't doing that right then and there. Hence, why do we want to use that stop? Well, because if you are early, you stick to your profile, you're out of the trade, gives you the opportunity to step back and go like, okay, what is going on? I see they still have more to sell. Now they're going to move down to my next level, which you're going to have to let happen because maybe your trade, exactly the one you just had, and that is to go long. So sometimes we get a little bit too fast on taking what we believe is a signal. All things that you're going to learn. But in that learning process, stick to your trading rules. The most important one being, where's your stop? And because we all want to live to trade another day. It can be very defeating, even to newer traders, even to mid-level traders, even to longer-term traders, to take a big hit. Suddenly you're feeling defeated, you're feeling down, you're like, oh my God, now I got to go make this money back. And it's just right before we go into a sideways move. So these things present themselves in a very hard way. And when we're in a sideways move like we were here, oh my God, painful, very, very painful, because you had to wait and then you didn't really get the move and then you didn't get enough. So trade rules are vital. And I'm going to put this open to, if people have questions, if you have something, a particular market you want me to take a look at, please, now's the time. Put any questions in or any stocks or indexes that you have an interest in, and I will try to take a look at those for you. But in the meantime, I'm going to continue to talk about coaching, about having trade rules, about following your trade rules, about following your trade plan. And your trade plan is like, what, again, I say, what is your trigger? There could be a pattern. You see the pattern, and as I do, and my patterns are going to be under Elliott, right? If I'm counting and I'm looking and I see that I got 5 waves up, I'm going to be looking for 3 waves down. This is on the hourly chart, but I can bring this all the way down, and I could look on my very short-term charts. These are 5-minute. These are signals to buy and sell. So I can see that on my 5-minute chart, I'm still in a sell, but I see that they're bouncing back up, right? So I know that I'll get triggers, and this will get a trigger to turn into a buy if we come up above the 4 and the 8 and break cleanly above it. And the 20 is tucked in there as well. Now, over in the S&P, I continue to have a sell signal as well, a little bit further away. So you may, if you got into this short, and let's say the trigger really would have been about right there, 41.83, you're going to want to start protecting. So here's part 2. You're in a trade and it's a good trade, and now you're making money. Where's your stop? Do you have a trailing stop? Do you know how to move that trailing stop? If you're using NinjaTrader, you can put that all in automatic. I really highly suggest that you learn how to do that, because it's going to save you a ton. Sometimes a market will move very quickly, and if you don't put it in buy at the market stop, you're buying at the limit, it goes right through your limit. Suddenly you're left there bidding or offering at the limit you just told the computer to do. And there you sit, and the market's like heading in the other, away from you, away from you, away from you. So things to learn, things, how do we want to do this? How do I determine the patterns? Learn. How do I look at moving average? What do they mean? Learn. What are the fib levels? How do you derive them? And is there a fib system? Yes. Learn about it. Being an independent trader has a ton of challenges, and you need to kind of learn. It isn't just as easy, like, well, I'm just going to buy or sell and wait. Doesn't work like that. Maybe on some days it will. And there are days where you're like, wow, I got in and I just made $1,000. It's like, yep, they exist. Today was one of them. Both directions. When it decided they were going to sell it, they were very aggressive sellers here. You could have made some very nice money, even on a 1 lot, which is $50 a point. And you can see, even if you got in here, let's just say you were really lucky and you got in at 41.98. The first down took it over. It was 12 S&P dollars, $50 a point, $600 trade. So the ability, that's a 1 lot in the S&P future on that move. If you were able to hold it, you would be picking up, and say you got anywhere close to this low, that was a $20. Now you're looking at least $1,000 to $1,200. They exist, but you got to have a mindset. You got to be ironclad, and you have to have all of your I's dotted and your T's crossed, so to speak. And that is knowing how to function using a trailing stop, having the ability to actually move that stop faster than maybe you thought you would want to. So there's a lot of things in play here that we need to keep doing. And then Rye Joyce 15 asking, do I offer mentorship or courses to teach? I do. I offer that via coaching. And I'm going to give you, where am I coaching? I think it's on both, but there you'll be able to find it. And how I run my coaching, I have a trade room. And right now I'm going to be changing that trade room around a little bit, because what I like to do is I offer coaching. And if you're buying a series or a group of coaching sessions, you're going to get a break on the price, of course. But I include my trade room because I think it's best to go live. Get in there and trade live. And David, if you wouldn't mind, also include TradersHelpingTraders.com, because you'll find that information on both. So thank you. So in essence, I like to use a live situation. I think it's like to try to trade, teach somebody like, well, if you had entered here and got out here, it's like, how about I want to see that live? How did it really trade? This is a 5-minute chart. Each bar is 5 minutes. So within 5 minutes, it dropped $10, $12. Within the next 5, it kind of hung out. The next 5, you can see what it dropped. But it took 5, 10, 15, 20, 25 minutes to get down to that low. How do you think you're going to handle it when you're trading? Whole different world. That's why I like to actually do it. Because you're running your scenario. You're running and you're looking for, if you're seeing a market that's running up, whether you know why. So I'm going to work on mindset with you. You know, the biggest thing about a mindset is you got to set parameters. And if you can't see me, but I'm taking my hands and I'm putting a big circle around my head. And what am I going to try to do? I'm trying to lock out the noise. What's the noise? CNBC, Bloomberg, having been, trying, who's buying what? Why are they buying that? Why are they buying Apple? Why are they selling this? Why are they doing that? And I'm going to tell you straight out, who cares? Because by the time you figure that out, your trades happen 14 times and you've missed it. I love the conversation after. Oh, wow, did you see what they were doing in Apple? Was somebody put out a recommendation? Oh, great. Did you pick up some calls? Whatever. That's an afterthought. But if you're in there trying to trade the future, of which Apple, particularly NASDAQ or S&P, NASDAQ is the heavily weighted stock in both of those indexes. Apple can move 5 or 6 cents. I'm not being serious here. And the NASDAQ future will move $5. And I'm not joking. It's because of how heavily weighted, because it's capitalized, it's cap-weighted index. Apple is still a $2 trillion company. It's the heaviest weighted stock in the Dow, the S&P, and the NASDAQ. I think also maybe even in the Russell. So you can have a group of stocks control the move. Do you want to spend time trying to figure out why they're doing that? Or do I just want to watch price action? Price action, is it forming 5 waves up? Is it forming 3 waves down? Is it breaking above my moving averages? Is it holding above my moving averages? What are my fib levels on my 5-minute chart, on my hourly chart, on my daily chart? What levels are going to be important? If it breaks, it's going to produce a little bit more of a quicker push. Oh, they're still in this relief rally today. Well, what are they doing? Right? We already know, probably from coming in, I'm going to be telling you, you know what? We're seeing this large allocation back into high tech. Regardless of what's going to be coming, it doesn't mean that they're turning bullish. How about this for a thought? What they're doing is they're buying stocks that even if we go into a recession or the market collapses, they're looking that they'll still be able to beat the market. That their portfolio won't go down as much because these stocks are more heavily weighted and more popular, and they will hold up better. This is what's happening. So again, to try to approach, well, why, if you're bearish, Michael, why are you watching a market go up? It's like, because I'm not bearish. I have a long-term count that suggests that after the primary B wave is done, we're going to get a primary C wave that's going to show us what a collapse really looks like. Doesn't mean I'm bearish, because right now it's a counter trend rally. And if I want to trade it, I better get on board. Be able to buy and to be able to sell based on the price action, not on what you think the market's going to do. Because the minute you think that and you hold on to it, the market will do something different. It's just the way things go. I got about one more minute. So if there's any last questions, while I'm just saying, thank you, David. I really appreciate it, and being able to come in and talk with folks. I will also tell you here, and you can and there is my email address. If you have questions, I answer my emails. I really do. I will answer you. I will try to answer your questions. On YouTube, go to Traders Helping Traders on YouTube. But please, someone hacked it. We own it, but someone hacked it, and they're using it. And trade with your trade rules. What important lesson did I learn trading? Have trade rules and honor them. That's the biggest thing I'm going to tell you. That's the biggest thing. Have a strong mindset and try to not let the noise come in. I am going to have to end it there, folks. Email me questions. Love them. I'll answer you. I hope that I tossed out some information that was helpful to everybody. And again, thank you, David. I'm going to turn it back over to you.